Welcome out. We've got a great speaker today. This is a topic that we're all feeling. So no one can fall asleep today. You got to pay attention and be part of the solution here, because I'm excited to hear from Joel and what he's got to share about where we're at and where we might be going and how we might be able to help with that. I'd like to invite Lauren up, who's going to lead us in the Pledge of Allegiance. Lauren Erickson, if you'll please stand.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you, Lauren. Just a few brief announcements. First and foremost, Facebook has declared that today is Support Your Local Chamber Day. I just saw it this morning, so I can't verify whether it's true or not. It might be fake news, but we're just going to go with it. So, but with that, I did actually just want to say thank you to each of you for being here, for your support of our local chamber. It's amazing to see how resilient this chamber has been over the last 18 months, 24 months with COVID. And that's because of our awesome members who have been there, stood with us, supported us, and moved us forward. So please join me in giving yourself a round of applause for all you've done. A quick shout out, of course, to the awesome staff here at the courtyard. They always treat us so well. Please join me in thanking them for their hospitality. And of course, to our board members, sunshiners, committee leaders, raise your hand, all of our chamber leaders. Thank you for your committed leadership in the Chamber of Commerce. I mentioned Facebook, and I'm going to mention this again as I do every week. Pull out your phones, leave it on the table. We want you to take pictures, video, and post it about today's lunch. Again, this is such an important topic, so help us get the word out about what we're talking about today, and make sure that others know about these in the future as well. We are very fortunate today to have one of our Board of Governors members who is our sponsor for the lunch, which is Alta Bank. And I'm going to turn the time over to Mark, who's going to give us a little more information about Alta Bank. One word, Alta Bank, one word. I struggled with this for far too long, so I'm going to make sure everyone here knows this is atoning for my sins, okay? Alta Bank, one word. But Mark Peterson is VP here at Alta Bank, is a tremendous leader in our community and such a great supporter of our Chamber of Commerce. He's going to also introduce our speaker, so please join me in welcoming Mark.
Good afternoon. So is that working? Great. Alta Bank, yes, it is one word. We are the largest community bank in the state of Utah. We have 25 offices throughout the state and one office in southern Idaho. You've probably known us by different names here at one point in time, Town and Country, then People's Town and Country, but we went through a rebranding about 2 years ago and we are Alta Bank. We're going to keep that name, but to make it more confusing, we're recently acquired by Glacier Bancorp. Glacier is a bank holding company out of Montana. It owns 17 community banks located in 8 Intermountain West states, and they operate semi-autonomously. And so we will continue to be Alta Bank, a division of Glacier, but we're very happy that we're staying with that. So Alta Bank strives to create value for its customers, both businesses as well as individuals, by providing collaborative efforts to come up with financial solutions to meet their needs. Our goal is to be the best bank for your business. We do have our main office, which is located at Flood and St. George Boulevard. You probably have seen our sign at River Road, and you've probably seen it for a while, and people often ask, Mark, what's the latest? And so, yes, we do hope to break ground there in the very near future, and so that's at 1450 South and River Road. And Don't have a specific timeline, but I'm hoping that we break ground before the end of the year. We are very proud to be sponsors of the St. George Area Chamber of Commerce. We are enthusiastic supporters of Don and his team that he's assembled, and we're very pleased to be sponsoring this luncheon today. I had the opportunity to meet Joel a little earlier here and looking forward to hearing his comments. Joel Griffith earned his Juris Doctorate at the Chapman University Dale E. Fowler School of Law with a dual emphasis in alternative dispute resolution and federal income taxation. He is currently a member of the State Bar of California. Following law school, Joel managed an equities trading account utilizing market-neutral strategies, which I find fascinating. That is a mouthful. As an attorney, he worked with Heidemann, Nudelman, Kalick, PC in Washington, D.C. Joel is currently a research fellow for the Institute for Economic Freedom and Opportunity at the Heritage Foundation. Previously, he worked as a researcher for a former member of the Wall Street Journal editorial board. Joel also was a deputy research director at the National Association of Counties. Most recently, he was director of the Center for State Fiscal Reform at the American Legislative Exchange Council. Numerous media outlets have featured Joel's written analysis, including The Hill, The Wall Street Journal, Forbes Online, Investors Business Daily, The Washington Times, The Orange County Register, and Times of Israel. He also made appearances on Fox News and Fox Business News. Like Don, I look very much forward to hearing what Joel has to tell us about the current economic condition and something near and dear to our hearts, whether we are business owners or consumers, and that is inflation. So help me welcome Joel Griffith.
Well, thank you, and thank you to the Chamber for hosting me, and thank you to my friend Jordan Hess, who I used to work with for several years, for having me out here today. It's actually my first time in St. George, and I'm wishing when I lived in California I would have gone an hour past Las Vegas. I didn't know it was so pretty here until I went hiking yesterday, so thank you. So let's see if I can get this to work. There we go. So the topic today is, are we becoming a nation of inflation? I think it's important to get started off by talking about what exactly is inflation. Well, inflation is an overall increase in the price level in an economy, and that's really what we're seeing right now. I know we've all experienced it pretty much in every category, whether you're going to the grocery store, filling up your car, paying your rent. Everything pretty much across the board has been increasing in price at an increased pace over the past year or so. And that has caused a lot of concerns that I know we're all concerned about, especially those of us, or those of you, I should say, because I'm in the nonprofit world, those of you in the business community. So this overall increase in the price level, that is an important distinction to be made between that and a localized or business-specific increase in the cost of a good. So what am I talking about that? Well, think about when you have a drought, for instance. You might see the price of apples or almonds increase because of that drought. Or you might see an artificial government edict like a restriction on fossil fuels that could cause a specific product to increase in price because of that regulation. We saw over the summer, the pipeline that was hacked on the East Coast resulted in gas prices temporarily increasing dramatically just in the course of a few hours. Or think about a hurricane that hits Miami. Well, the cost of plywood is going to increase before the hurricane approaches. Those aren't really examples of inflation, even though the price increases. Those are product specific and are caused by natural disasters or a non-monetary government policy. But what we're seeing right now is across the board, and that is a general price level increase. That is inflation. It's not a new phenomenon. In ages past, you had kings, you had emperors. They required commercial transactions to be conducted in the coinage of the kingdom. They had a sovereign mint. You would take your gold, your silver, your bronze coins in, they'd stamp it. That was your legal tender. That had to be used for buying and selling goods. And the Crown would benefit. The Crown would charge a minting fee. But what the Crown would also do from time to time is when the gold and silver would come in, they would dilute it. And they would take off some of that gold and silver for themselves, maybe to spend on their constituents, on their loyal subjects. And they would give the person back that coin. And they required that that be used as legal tender. Well, over time, you would see the prices in that coin would rise because the quality of that coin had been diluted. It was no longer pure gold or pure silver. Well, in modern times, inflation has become the expected norm as we moved away from a true gold standard, paper currency backed by gold. And now we have our central banks that churn out paper or digital fiat currency that is really unlinked to anything. That's why they call it fiat. They can do it at their own discretion. Now, in some parts of the world, the end results have been absolutely disastrous. I'm sure we've all seen stories of what's going on actually, in Zimbabwe, in Africa, or closer in Venezuela, where prices of goods and services are rising at thousands of percent in just a month or two time span. In Germany, during World War II, you saw the destruction of the German mark as the regime there printed as much as they needed to run the military operations. And in Argentina, they experienced 1,100% inflation annually back in the 1980s. In fact, from 1980 to 2005, 24 nations experienced hyperinflation of 1,000% in a single year. Absolutely astounding. Well, here in the United States, we've had inflation for many decades, but our central bank has pursued a less negligent course, albeit still economically harmful. We have seen over the past century our supply of money grow more rapidly than the aggregate level of goods and services produced. So we've seen modest inflation, typically 1-2% a year. Sometimes back in the 90s, I think once in the 2000s, we actually had deflation for an entire year span. But for the most part, we've seen fairly steady over the last few decades, 2.5% inflation rates. Well, with this in mind, that we've actually have experienced inflation for the last 100 years in the country, I find it a bit amusing that recently the New York Times had an article saying, inflation is here. What now? Well, it's a bit misleading because we've actually have had inflation in this country for 100 years. It's just that over the past year, we've had some of the highest inflation rates in the lifetimes. If you're 20, 21 or younger, you've never seen this type of increase in a given year in rent, for instance. But it's certainly the highest rate that we've seen in many years. In fact, I think the last time we didn't see this was, or the last time we saw this was several decades ago. So I've got a chart here just to show what we all know, that inflation has been elevated at 4.4%, 0.6% a month going back a year now. One of the biggest ways this has been evidenced is in commodities overall. Now, this commodities chart shows that relative to pre-pandemic, the basket of commodities ranging from orange juice to oil to gold, going back to pre-pandemic, not going off that low point of 2020, but going back pre-pandemic, commodity prices are up about 50%. And that's just the average. If you're building a home, lumber prices at one point had more than quadrupled since pre-pandemic. Oil is on track now to nearly double since pre-pandemic. And then precious metals or elements such as uranium have gone up even more. So this has been dramatic. And this feeds in to what we're experiencing at the grocery store. I mean, corn is up, last I checked, about 80% over the past year. And that impacts your fuel because of ethanol. It impacts your cereal, of course. It impacts the hamburgers that you buy to grill up because cows eat corn, obviously. So overall, we've seen this happen. But something that's not talked about as often are things such as home prices. Home prices have been increasing for years now. We're about 40% higher now, the typical home price, than we were before the last bubble. And if you look at some of these smaller towns, I was looking at some of the smaller towns on average in Michigan the other day just to get a sense. And people that own the homes are enjoying this big increase in the price. But if you're a family that's looking to start out and buy a house, you're finding that year-over-year increase in a home price is a factor sometimes 15 to 20 times what you typically expect in some of these smaller towns. And this is definitely impacting middle class families. Anecdotally, I have a younger brother and his wife and 3 kids that, because of rising home prices in suburban Atlanta, they found it necessary, because they want to live on one income, to actually move out of state. And it's wonderful that we have that ability to move from coast to coast in this country. But as we'll get into here in a bit, when you have government policies that are creating the problem and forcing people to sever ties with their communities and their religious communities and their businesses, that's very important and unfortunate, because people should be making these decisions not because government is forcing them into it with bad policies, but because you have your own desire to make such a move. Another thing that I really wanted to discuss was labor cost inflation. I know a lot of you as business owners or business managers have struggled to find workers. In fact, more than 40% of small businesses are reporting a problem, a labor shortage problem. Of course, it's not that we've had people disappear in this country. They've just disappeared from the labor force. And this is the first time in our nation's history where, in effect, you've had private enterprises competing not with other enterprises or government jobs, that you're actually competing with an unemployment check, which of course is driving up labor costs as well. Not to mention the fact that the labor supply has been artificially suppressed by those that are fearful of going back, that in other parts of the country had to deal with the school situation and childcare situation, is driven a lot of people from the workforce, and so we've seen those labor costs increase as well. And one other evidence of inflation is something, too, we don't always connect the dots with inflation in this, but the stock market. I know I was talking to someone about the crypto surge, and I've been in some in the oil markets lately. These asset classes are booming. But if you look at this chart, and this is the total market full cap of all the publicly traded companies here in the United States, the Wilshire 5000. We are at record highs in terms of total market cap. And what's really astounding here, if you go back, once again, I don't want to cherry pick data and go by the pandemic lows. So we'll use the pre-pandemic high point. We have seen the total stock market capitalization increase by roughly 30% since pre-pandemic. Now I want you to ask yourselves a question. Do you think our economy is 30% larger than it was since the start of the pandemic? Are your businesses on average overall in this country doing 30% better? Is a typical person's income up by more than 30%? And the answer to those questions, at least overall for most people, is no. But yet our stock market is telling us things are wonderful. So yeah, what is going on here? Because that is inflationary, what's happening in the market. Despite the fact that many are benefiting from it, that is another evidence of inflation. So, well, first off, federal spending. Now, federal spending in and of itself is not inflationary. Federal government gathering tax dollars and spending it, that's redistribution of wealth. It might not be the most prudent thing to do economically, but in and of itself, increasing federal spending doesn't result in an overall increase in the level of prices. However, as you know, in our country, much of our budget is financed by borrowing. Well, again, borrowing money in and of itself, too, doesn't drive up inflation. If you're borrowing from a private investor, once again, it might not be the best economic decision. If you're taking from a private investor that could invest in a business or start a new business or invest in new technology, and instead you hand it over to the government to redistribute, well, it's not the best use of the money possibly, but that does not in and of itself drive up inflation. But what we've seen in recent years is I would say recent years, particularly the past year and a half, is we have seen federal spending explode. Here's the chart that shows federal spending on an annual basis went from $5 trillion just before the pandemic began to, on an annualized basis, spiked to $9 trillion. $9 trillion. Think about $9 trillion. Divided by 300 million people, $9 trillion on an annual basis is about $100,000, close to $100,000 for a family of four. It's a lot of money. And we've stayed at these elevated levels now, not just during the initial few weeks of the pandemic, stretching all the way through the end of 2020. And now we're still at this nearly $8 trillion annual spending level a year and a half into this pandemic. And most of this, actually all of this new spending, that's not financed from borrowing from private investors really, or from tax increases. What we've seen done is we've seen our central bank print digitally a lot of financial resources, buy government bonds. So the Fed owns the bonds, the new money goes to the federal government, and then the federal government spends those resources. In effect, we've had our central bank financing the federal government explosion in spending. We're at a point now where politicians know that they can rely upon the central bank that will oblige them, that'll buy the debts of the government and allow them to continue to spend. And what they're hoping is that over time, regular people that are busy running their lives and raising a family, they're hoping that people don't realize that the resulting economic havoc and the slower growth and the higher prices, they hope the public won't recognize it. And usually over the last few decades, they've gotten away with it because with our relatively free market, we have a general increase in productivity. So people are more productive at work, and usually we get to share in some of those resources. So we're a very productive population. We're a relatively free market. And so for a long time, the government's gotten away with financing the debt and doing the borrowing. But things have really changed this last year and a half. And here's the federal debt owned by the Federal Reserve, where they've actually printed the money digitally, transferred it to the federal government, and then taken on a bond in return. You see that the federal debt owned by the Federal Reserve went from under $3 trillion around the time the pandemic started and has nearly doubled in just a year and a half. Now, I want to be clear that not all of the inflation that we've seen over the last year and a half has been the fault of the Federal Reserve. I think I skipped over that, but I do want to mention that. We've had other factors at play here. We know that we've suppressed the supply of goods and services. For a while, we criminalized people going to work. We criminalized businesses from opening. And then we also, because of some of these were prudent restrictions, possibly, but with the distancing requirements, and you have manufacturing centers, and you have the shipping industry, we had a big suppression of supply and goods and services. And that's partially to blame for the inflation, because at the same time, we had an increase in demand because we had the federal government borrowing and pushing forward that demand artificially. But I want to be clear, not all the inflationary impact have been caused yet by the Federal Reserve. Some of that was were other factors. But in conclusion on this point, I will say governments do have a vested interest in being able to have their central banks print these resources. And oftentimes we just simply don't notice it. So the long-term impacts of higher, go back to this one. I get lost in these numbers, so my apologies. And look too at the total Federal Reserve assets. The government debt is not the only asset that the Federal Reserve has been buying. We've seen the Federal Reserve also buy up a lot of mortgage bonds, corporate bonds, other investments, and that also does tie into the housing market. It's one of the reasons why the industry is awash in funds, because when these loans are made and they're packaged up, it's not just selling these loans out to investors, private investors. You have our central bank printing the money, purchasing those loans, and now you have those investors with those tens of billions of new dollars, and they need to park that money somewhere. Well, that money's either going to be put on deposit at a bank or it's going to be put into other corporate investments. And that's another big part of the reason why we have seen our stock market explode in valuation, despite the fact that our economy is roughly the same size as it was pre-pandemic. We have a stock market 30% higher. It's partially due to the fact that we have investors that are flush with cash because they're selling their investments in some of these industries straight to the central bank. And you can see there the total amount of assets that our Federal Reserve has purchased has more than doubled from under $4 trillion just about 2 years ago to $8 trillion today. And something we have to ask ourselves with that is, what happens to the rest of those resources? It doesn't all get poured in the stock market. Well, a lot of those new dollars have been parked, have been put in deposit at banks. And of course, banks make their livelihood by earning an interest premium between what they're paying depositors and what they're lending out at. Now, if all that money were released in the form of loans and then deposited and then re-released, you end up with a multiplier effect of all this new monetary base. And you see the monetary base itself has nearly doubled in just a few years. But the Federal Reserve, they recognize that if all this money that they've created that ends up on deposit at banks, they recognize that if all of this were lent out, we would be in a really much larger inflationary problem. So what the Federal Reserve has been doing to stop that from happening is they're actually paying banks to keep excess money on reserve rather than lend it out. So now, in effect, we also have a competition going on where you as a borrower, you're in competition with the Federal Reserve for the money that is parked at these banks in deposit. Now, so long as the Federal Reserve is willing, continues to pay this elevated interest rate on those reserves to induce the banks that are not lending out those resources, they can hopefully keep that genie partially in the bottle, that inflation genie. But there's a lot of hope there. This has not been tried before, and as we've seen over the last year, they have not been entirely successful with that mission. So the long-term impact here of inflation, I think there's a good quote by an economist, Henry Hazlitt, and he said it best: inflation unbalances, it reduces, it misdirects production, it leads to unemployment and to malemployment. Well, something that we've talked about just briefly is that in a relatively free economy, we're able to become more productive each year thanks to investments in technology. We can do more with every hour that we work. But over the last 10 years, we've seen prices that rose 20%. We saw our incomes increase 30%. So the average person is better off. But it's important to have people think about how much better they would be, how much the lifestyle would be better if instead of just benefiting a bit from the increase in productivity, they're actually able to benefit more. And the government is siphoning off those gains. Another consequence longer term of this higher inflation, it erodes the value of your savings accounts. It's a hidden tax. With elevated inflation over several years, and think about what happens. Even if you have elevated inflation of 8% for just 4 years, you've lost, in effect, 1/3 of the value of those financial resources if it's in just a typical savings account. Another thing to keep in mind is your capital gains. When you're taxed on capital gains, you're typically taxed on the increase in the absolute value of that asset. If you've got inflation of, say, 5% per year, and you have an asset that's appreciated at 3% per year, when you sell that asset, you're taxed on that 3% annual appreciation. But if inflation is running at 5%, you obviously don't have much of actually a zero gain, but yet you're still taxed on it. So in effect, in that instance, inflation acts as a hidden tax, as a hidden wealth confiscation tax. We also see a lot of distorted price signals. A lot of business uncertainty. It's very hard to plan ahead. It's very hard to actually enter into long-term contracts when you have higher inflation, especially when you have inflation that is far more volatile than we've seen in years past. And something else that's not always discussed, I think, is very important as far as an inflationary risk, is that although those of financial means might be benefiting for now from these higher inflation rates. I mean, think about those that are heavily invested in the markets, especially if you're leveraged long the markets, seeing this explosion in asset valuation in real estate and commodities and stocks. If you're invested in it, you've done very, very well. The wealthier are growing wealthier. And during this environment where the government is printing and borrowing to transfer some of that wealth to those at the very bottom, those at the very bottom are actually doing better right now than they were a year or two ago as well. Because of all the government aid and all the credits. But those in the middle class and upper middle class, they're the ones that are getting very squeezed by this right now. A lot of them, I would say, aren't hedging their rising gas costs with oil futures. I would say a lot of them probably aren't leveraged long the stock market if they're invested at all. Well, I can guarantee that if we enter a real economic crisis because of this fiscal mismanagement and monetary mismanagement with higher inflation, if we enter into a severe economic crisis because of this, the blame is not going to be placed on the left-wing politicians. The blame is not going to be attributed properly to crony capitalism. The blame is going to be put on our free market economic system, even though that is not the actual culprit. I think it's something politically to keep in mind. Lastly, but something of also importance on the inflation front as a danger, our national security is also on the line. Right now, I'm going to go back to this chart real briefly. Our fiscal health right now, this is from the Heritage Foundation Economic Freedom Index. We rate countries on a scale on a multitude of factors from moderately free, most free, all the way down to repressed. Think of a place like North Korea or Venezuela. Although our business climate overall is mostly free, we're in the top 15 of all countries, our fiscal health is amongst the worst of our economic competitors, amongst the worst in the world. In fact, the Heritage Foundation, we now rank our fiscal health as repressed at a 35. Well, what that means relative to our competition is that we do run the risk of our dollar losing more of its value, not just in terms of what we can purchase at the grocery store, but our dollar losing its value relative to other global currencies. And right now we're in a privileged, something we worked for, but a privileged position of the rest of the world primarily relying on the US dollar for international trade and for banking. And because of that, when we want to crack down on a terrorist organization or a terrorist nation, we're able to implement sanctions. And countries aren't complying with us necessarily because they admire us. They're complying with us on a lot of these sanctions because they know they won't have access to our banking system and they won't be able to do their business with US dollars. Well, once there are other alternatives to the US dollar, those nations that aren't our natural allies are going to have far less of a reason to actually comply with our sanctions regime. I think it's important to recognize that our ability to use our banking system to stop these horrible activities from occurring and to block out bad actors, that helps us not just because it protects us from terrorist attacks, it also means that we don't have to put the lives of our young men and women in the military on the line nearly as often because we can rely instead on the sanctions regime. Well, if our dollar loses its place in that hierarchy, which still it's number one, we run the risk of no longer having that strength. Which brings me to something that's been discussed a lot in the economic circles as of late, including during the last primary season. This idea of what's known in DC and economics departments as modern monetary theory. And modern monetary theory used to be laughed at, used to be scoffed at, because it's the idea that we can just create unlimited streams of new fiat currency to directly finance government spending. And then, if inflation hits because of all the new dollars circulating, we can just have the Treasury Department increase tax rates and soak up the money. Because we all know politicians are so quick to raise taxes to pay for their spending rather than to borrow. So that was the theory. Well, in effect, this would give Congress literally a blank check to command and control allocation of government resources. Worst case scenario, you end up with almost full government control of the economy along with high inflation. Best case scenario under this theory would be you have far higher taxes. So in effect, this theory defies economic and political reality, just like the Flat Earth Society still rejects geographic reality. But as much as we should laugh at that, we basically have been trying that now over the last year and a half. Because even though our central bank is technically independent, technically not the federal government, you have seen the Federal Reserve print the resources, give it to the government, and exchange the bonds as we discussed. So in effect, that's been what's happening, and we're starting to get a taste of what modern monetary theory would look like with these higher prices. So what can be done? I think it's very important to recognize that inflation is a political problem and there is a political cure. But this requires that the public in general become more informed. Because only when they become more informed will this translate into actually choosing the right people in Washington, D.C. to represent us. I think I think the present situation where for the first time I can remember, I've loved talking about this stuff since I was a weird kid, since I was a kid. I don't remember this coming up in conversation so randomly, not just in DC, because I'm living in the free state of Florida right now. It's coming up in conversation with non-political friends in Florida that are running businesses, operating businesses, trying to buy a home. They're talking about this at almost every event I go to, even before they know what I do for a living. They're talking about this, and I think that gives us a rare opportunity to really explain to the public what the root causes are of this. So my hope is that even after this episode passes of this heightened level of inflation, I want people to start wondering how much better their lives could be each and every year because of their hard work if it weren't for the government taking advantage of that increase in productivity. Now, there's no free lunch. The monstrous expansions of government spending that are proposed by the far left, it's going to come at a cost. And we're going to pay for that either directly through taxation or higher borrowing costs as you have the private sector compete with the government eventually for resources, or as what appears more likely now, the hidden tax of inflation if our central bank is relied upon to do the financing. And if this past year serves as a guide, I think that our government is in the position to go that latter route and to have the financing come through the central bank to avert a dramatic increase in the actual tax rates. But as we know, inflation too is a hidden tax. It's a very real tax, and it affects rich and poor alike. So we have to have a Congress that is willing to rein in the power of the Fed, put it on the Federal Reserve, put it on a more rules-based system. And then on the shoulders of our people in Congress, we need real reform, not just on spending caps, but on revenue caps as well, as some states have done. You know, these realities, I know they don't make for a really good stump speech for most politicians, but they have to face these realities now, or we're going to have far more dire consequences down the road. The expansion of our federal government, particularly when financed by our central bank, threatens our prosperity and our economic freedoms. And with that, I just wanted to leave with one of my a quote from one of my favorite poems. You probably had to read it in elementary school. But we were promised abundance for all by robbing Peter to pay for collective Paul. But though we had plenty of money, there was nothing our money could buy. And that's from Gods of the Copybook Headings. And if you haven't read that poem, it's one of the best. And I think you'll realize that even though he wrote that going on 100 years ago, it really defines the state of society we're living in today. So thank you very much for having me. And do we have time for questions? Yes.
So you hear in the news about 5% inflation rate, but a lot of the charts that you showed doubling a lot of things, gasoline among others. How does that pan out?
Yeah, great question. So the Bureau of Labor Statistics has their basket of items and services that they use to compute the inflation rate. And those numbers, there's some very skilled statisticians there, but I think you're right that for a lot of Americans, it doesn't really reflect the reality they're living in. For instance, one of the basket items is it's usually a lot of electronics and big screen TVs. And sure, those have not increased at the same percentage rate. In fact, those have gotten cheaper over time. But if you're in a lower middle class family, maybe you're not constantly upgrading all these electronics or these items within your household, and your paycheck is going more to getting to work or to paying your heating and your cooling bill or rent on your home, your numbers personally are going to be a lot higher than that 5%. Case in point would be rent. And I'm going to leave St. George and Miami and these beautiful areas that are attracting people out of it. So I don't want to cherry pick data because I know there's other draws here. But if you look at, I think it was Kansas City, was it St. Louis or Kansas City? I think it was Kansas City, Missouri, saw a 15% increase in rent last year. And that's not because people are moving to Missouri because it's a beautiful place and a great climate. It's rising costs overall. So yeah, that 5% is not necessarily indicative of the typical person. But even if it were, when you have real wages often or wages overall that are increasing 2 or 3% a year, or even if your cost of living is only increasing by that 5%, that is a very real hit to your personal bottom line of a few percent per year. And if you extend that over 5 years, You're talking a 10% decline in somebody's standard of living? That's very significant. Yes.
It feels a little out of control for the average person, right? So what would you recommend that an individual can do besides obviously try to vote and change political things that way? But is there anything we can do as a society and individuals to help with this? Because I just think of children and our, it's just like, gosh, this seems depressing. And is there a way for us to, like, I think the 70s were kind of like this, and obviously we kind of figured it out, but is there?
No, it's a good question, because we as individuals, no matter how much we care, we're limited in actually changing what's going on. We're not going to have an impact on the next Federal Reserve chair or maybe the next budget director. We're not going to replace Senator Sanders in the Senate on appropriations individually. So we're going to go through a period of time, possibly, where the government continues to act imprudently. I think it's going to be very important for young adults especially to take charge of their personal finances. And sure, you might not be able to affect government spending or the rise in your rent, but there are things that most people can do to still live under what they're bringing in. And it's important that either they do it on their own or through a financial advisor. I think it underscores the necessity for kids to actually get that basic financial education so they can go ahead and save, even if it's 3 or 4% per year, live frugally, save that money so they can weather the storm.
Yeah, I have a good friend who lives in Venezuela, and she would literally buy cars to sell. Like, she would not leave her money in the bank. She would just buy cars because they would appreciate and sell cars. And she was like 21. That's like what they did for their banking system. So is it like invest in actual assets?
I want to, but I know I can't give actual investment advice in this. But I do think it's important that people max out their 401ks and their IRAs, because you're not just limited to any one particular asset type. You can do mutual funds, you can do individual stocks, you can do real estate even if you do it right. So I think there are ways that we can mitigate the impacts. I know I mentioned the buying oil futures, only half kidding, because that is one way that some people are mitigating. Companies mitigate the inflation risk. Not recommending that for people, but there are ways to mitigate these risks. But I think people have to be a lot more on their feet than they would have been in years past. Because if we continue down this road, the opportunities just won't be. They're not going to be as abundant as they may have been prior. Yes.
Would you explain how the falling GDP, gross domestic product, affects this as well?
Yeah. So GDP in general, over the last few decades, we have seen real gross domestic product increase on an annual basis. It's been relatively rare where we see less output one year over another. During the pandemic shutdowns, of course, we saw the economy shrink. During 2008 and 2009, with the financial crisis, we saw the economy grow smaller. So over time, we've still seen the economy grow. We've still seen, even adjusted for inflation, the per person output increase, but it's been at a slower level in recent decades than it was in years past. And some of that is because our population overall is growing older, and so we have more people that are retired relative to the population. But another component of that is related to government spending. We've seen the federal government eat up more of that economic output, and so that leaves relatively less to actually invest in the private sector. And that's why I think it is difficult sometimes to communicate with people in the general public about this, because our lives overall are getting better. The middle class is shrinking, but not because people are getting poorer. It's because over time, the typical income in real terms has increased. It is harder to explain to people that, wow, your life could be even better if the government weren't sucking up those resources from these businesses and denying those businesses the ability to invest. It definitely shows up in the numbers, like you said, with the GDP. It definitely shows up over time. Our GDP growth rates have been lower than they were a few generations ago annually. But when let's say somebody's 30 years old and they don't really have that start point of 1960 or 1965 to know things used to be growing at a much faster pace. So it definitely takes some explaining and I think educating. And then most of our politicians just aren't doing that. Yes.
So, if you would share, I have a friend who invests in stocks of oil, loves it when the prices go up. He just gets all giddy, which I don't. You personally, if you had a little money to invest, where would you go with it right now?
Yeah, it's great. I have to be careful on that one.
We won't
I-
hold you to it.
I think something to keep in mind, since we're talking the energy sector, is this is another one of these areas where it's kind of blurry. We can't put all the blame, for instance, on the central bank for oil prices being at $84 a barrel right now. There's so many other factors at play there, and that's also makes it a bit of a risky investment because with oil you have things such as companies that have to decide and whether or not we're going to have our government crack down on fossil fuel production, or if we're going to subsidize green energy, or the supply chain disruptions. That's how you have oil that went from negative on the contracts, negative a year and a half ago, to $84 a barrel this morning. So I think it is very important for the typical person who's running a business, raising a family, that doesn't have time to be preoccupied with 5-minute trading charts. It really is important to have a valued advisor that isn't just in it for the commissions, but that actually has that big picture and can diversify that portfolio in a way that can at least minimize the risks that we face from governments across the world that are acting incredibly irresponsibly. I know it's not an exact answer, but I do think that advice is really important.
Thank you. That's
You alluded to some international there. That's what I want to pick up on. Can you explain any of this in a global context, right? I mean, as we look at the impact of COVID on the global economy, it's been dynamic, both positive and negative in its shift, but what impact does inflation have globally in our relationship with China, Russia, South America, major trading partners? Any insight that you can give us on that?
Yeah, so we could go one of two ways internationally. You could have kind of a race to the bottom where all countries are ramping up the digital printing presses equally, in which case, more or less, you'd see inflation be about around the same rate, which would be economically destructive in and of itself. You could see the race to the bottom, or you could see an instance where some countries perform far more poorly than others in terms of how they're funding their governments. Right now, our country's doing about the worst on this. We see that spending. We saw that $4 trillion to $9 trillion annually in the course of a year, financed by mostly printing. That suggests we might have maybe one of the more incompetent governments right now. And I'm not pointing the blame. I don't want to point the blame. This has been a problem over time that's been both Republicans and Democrats, especially over the long term. I mean, right now we're focused on $9 trillion in a year. That's not even the explosion of entitlement spending, which is really the long-term driver that's possibly could make us insolvent. This is just the annual. And both parties have been responsible over the longer term. It's just gotten a lot worse the last 12 months. So if we're in that race to the bottom and we erode the value of our currency relative to others, that's a big problem because that's going to be those national security implications. Yes?
Say 5-6 years ago, on average, the average American spent $1.22 for every dollar they earned, right? What does that ratio look like now, and is that also causing inflation, the fact that the Americans are getting deeper and deeper in debt themselves?
Good question. So we saw this strange occurrence during the pandemic where, because of all the government stimulus that had been provided, combined with there being fewer places to spend your money, we saw savings rates for several months hit all-time highs in this country. Now, if you look at, I think I had a chart on here, kind of illustrated this. There we go. So now as we saw the reopening, we've seen people start spending down their savings. So our retail sales now are about 15% higher than they were pre-pandemic. So it seems that people are starting to draw down on those savings. At the same time, one of the encouraging takeaways during this last year and a half are that the investor class definitely is expanding within the younger generation. And I think that bodes well, not just for their financial futures, but if you have more of those folks that are getting through college, recently finished college and starting families, if we do see a long-lasting expansion of that investor class beyond just the GameStops of the world, this could bode very well for their financial future, but also for the country's future, because when you have people that really have some skin in the game, whether it's through a house or whether it's through your investment account, your retirement account, you start taking a lot better note of what these folks in Washington, D.C. Are doing. Completely agree with you that overall, yeah, we do see people living beyond their means, and often they're being incentivized to do that by our own government policies that encourages people to take on these $500,000 mortgages when you're barely making $100,000 per year. Yes?
So you've demonstrated the inflation of the market, generally speaking. Obviously, that's not a direction that can continue. What is your guess about what's going to happen? So we've seen inflation. We've seen the inflation. Do you expect a market contraction, or do you think we're going to have a period of stagnation? How is the market going to rectify that?
I wish I had a real answer for that. There are a lot of uncertainties. I mean, if you look at basic market valuation, we know that market valuation relative to GDP, market valuation, whether you're looking at price to earnings, the levels that we are at right now are historically high. But are we going to correct? I mean, at some point we'll have a market correction, but to predict when and how big that correction will be, I think it's a bit of a fool's errand, because so much of this is actually out of our control. And you could have a situation where maybe the Federal Reserve continues certain policies that direct more wealth and more assets to the stock market, and we could see the bubble, if you will, continue to grow. So predicting when it's going to happen, or if it happens to what extent, a lot of that just isn't in our hands, and that's why I do think it's important to as any advisor would say, to be diversified and to know exactly how much you want to have at risk. It's good. All right.
Before we sit down, we got a present we want to share with you. A book from one of our favorite entrepreneurs that's been a speaker for us in the past. It's called What Awesome Looks Like. And thank you for being here today. This does not look awesome, but Joel is awesome, and we appreciate you coming out and spending this time with us. So give him another round of applause. Thanks again for being here. Obviously, important information that we as business leaders need to be aware of, need to be dialed in more, and certain things that we can be doing on our part, right? Make sure that we're sound fiscally in our businesses, personally. These are all important. It's just important information for us to have. Just a few quick final announcements. Friday, Donna, we've got our Chamber Serves project at the Children's Justice Center, and it's going to be fun, and it's going to involve tools. That's all I'm going to tell you. Do we need to bring tools, or do they have tools?
They have some, but if you have tools, bring them. And it's at 10 a.m.
Bring tools.
Allen wrenches.
Allen wrenches. Lots of tiny Allen wrenches. No, wait, they'll have lots of tiny. Bring ones that are not tiny, okay? Tomorrow morning, 9 a.m. is our launch of Startup Grind. As you know, we've transitioned from Start STG to Startup Grind, which is a global brand for entrepreneurs. We invite you to join us. It's going to be at the Work Turf Warehouse at 9 a.m. We've got free coffee, maybe free pastries, we'll see. But it's just a great opportunity to connect with other local entrepreneurs and see what's going on with their startups. And then finally, you've got on your tables our 30 in their 30s. We're excited to recognize, we've got a few of them here today, who we're going to be celebrating on November 4th. So buy tickets, come celebrate with us, have a great time. Please spread the word about that event so that we can recognize them properly. Thanks so much, and we'll see you next week.